So the overarching challenge for revenue mobilization is, simply put, to raise enough money to meet countries' development goals, at the same time doing it in a way that is generally accepted as being pretty fair. Now, that's, of course, much easier said than done. It has really, I think, two aspects. One is there's an aspect of designing the tax system, of tax policy. And there we have to be aware that sometimes, particularly in low-income countries, the taxes that we can use and that we think of as fair, say the property tax, simply aren't going to raise enough revenue. We're always going to have to put heavy reliance on things like the value-added tax, customs revenue in many countries that don't directly meet the objective of fairness. So there are so many difficult trade-offs to be faced there. Achieving this is also partly a matter of good tax administration, which again is more easily said than done in terms of building up systems that are efficient, that treat taxpayers fairly, and handle disputes and disagreements in a way that people find generally acceptable. So these are easily described, very hard to do. I think maybe it's also worth remembering a few things here. One is that if we look at the high-income countries, the advanced economies, with their highly developed tax systems, they didn't develop those overnight. Those took centuries to develop. They took 2 world wars to develop. So we shouldn't really think that these things are going to happen very quickly. These things take a lot of time. We have to be realistic in what can be achieved in relatively short times. I think it's also important to remember that tax is really only half of the equation. The other side of the equation is spending. And when we think about, in particular, building the trust between taxpayer and governments, without which no tax system is going to survive, it's important to think about the spending side too, in two respects. One is that for people to pay tax, they really want to see they're getting something out of it. They want to believe their money is well spent. Even if they don't directly benefit themselves, I'd like to see that it benefits society more generally. And the spending side matters too, because when we think about, for example, the fairness of the tax system, we really also need to think about the fairness of the spending side too. So when we think about, for example, the value-added tax, people sometimes worry that it's not directly a progressive tax, but at the same time, it can be the only realistic way in which one can finance social spending on health, education, that really does pursue equity objectives. One other important lesson, I think, is that improving tax systems is not spectacular work. It's hard slog. It's not a glamorous job, improving the VAT, improving customs. It's unglamorous work. For example, there's a lot of attention these days on international tax issues because they're very interesting, they're exciting. We're talking about big digital companies. And how these international tax issues are resolved is important for low-income countries. We would argue, in fact, they're at least as important for low-income countries as for high-income countries. But nonetheless, sorting out the international tax system is not really going to address the revenue needs in low-income countries. Doing that is going to be much more unspectacular, dogged, hard, sometimes, dare I say it, even boring work. But that's really where the progress, I think, is going to be made in developing revenue systems. Well, the value-added tax is now very widely used all over the world, including in many developing countries, and it really is now a substantial source of revenue. The VAT probably now raises about 20% of the world's tax revenue. So there's really, I think, no doubt that the value-added tax can be an effective source of revenue. That said, we know that in many countries the value-added tax falls short of many of the features we would like it to have. We would like it, for example, to be broad-based. We would like, typically, it's preferable if the VAT is not riddled by exemptions and reduced rates, which may look as if they're serving fairness objectives, but actually often tend to benefit not the poorest, but the better off. For example, reduced rates on food items. Certainly, the poor spend a larger proportion of their income on food, but the rich tend to spend absolutely more. So a lot of the benefit of these kind of exemptions, and I use food as an example, but one can think of others, actually don't really serve equity objectives very well, but they do reduce revenue that's available. There are various other ways in which many VATs still need to be improved. They need to be, for example, more effective in many countries in giving refunds to exporters. Without that property, the VAT risks becoming, in part, a tax on exports, which is sort of the exact opposite of what we want it to be. So there's certainly a lot of room for improvement in the value-added tax in almost all countries, not just low-income countries. But really, the VAT has certainly proved that its potential, and has realized much of the potential, for being a key source of revenue to meet countries' development objectives. So this is a paper about what's called residual profit allocation, which is a new approach to suggesting multinationals that's been getting a lot of attention in the last few years. To explain how it differs from current arrangements, at the moment when you tax a multinational, essentially what you do is you take all the subsidiaries, all the entities within the multinational, and you allocate the multinational's total profits to these different entities, which may be in different countries. You use that by a method called arm's length pricing. That is, you value transactions within the multinational. At the moment, that's implemented by something called arm's length pricing, which is a method by which you value transactions within the multinational at what you think are the prices independent, unrelated companies would charge. And a further feature of the current system is that, in short, you're only liable to pay corporate tax in a country if you have a kind of a physical presence there. That's been the basis of the international tax system for about 100 years. Now, very rapidly, we're talking about potentially quite a different system, which could have elements of departing from those principles in two ways. One, instead of looking at the entities within a multinational, trying to allocate profits within the bits of the multinational, you would allocate, or you would simply look at the overall profits of the multinational. And secondly, you might allow for some taxing rights to be given to countries in which firms are selling products. They may not have much of a physical presence there, but they're nonetheless selling products into those jurisdictions. So those are two fundamental departures from current traditional arrangements, which are embodied in these ideas of residual profit allocation. More precisely, what residual profit allocation does is it looks at the multinational, it divides its profits into two parts. First part is called routine profits, which for an economist more or less corresponds to a normal rate of return. And that part of the multinational's profits is allocated according to where the multinational's activities take place. So you allocate some routine return to functions and activities in particular jurisdictions. They then tax those routine returns. What that then leaves you with, when you subtract those routine profits from the total profits of the multinational, is a bit left over, and that's called a residual profit. And that residual profit you allocate across countries by some formula. It may be according to the share of the multinational's sales activities, proportion of its payroll, or its assets in those countries, but you allocate by formula. And a number of the proposals envisage that in the formula you would include sales. So as I was saying before, you'd have a liability in a jurisdiction where you're simply selling, where you might not have much of a physical presence. So these ideas are floating around in various forms, particularly in connection with the OECD G20 project on international tax matters, focused particularly on digitalization, consequence of digitalization. And these are issues that are coming up for very rapid discussion. The hope is to have some agreement, international agreement, on the new direction of the international tax system this year. So coming finally to the paper, what the paper tries to do is simply develop some first ideas on how this kind of tax system, this system of residual profit allocation might work. Because this is really such a new idea that economists really haven't thought about this. It's an idea that comes much more from practitioners, lawyers, transfer pricing people. So very little has been known about the economics of these schemes. Even, for example, how big are routine profits? How big are residual profits? How many companies have large residual profits? Which countries are those companies headquartered in? What would the movement to a scheme of this sort mean for revenue? Which countries would gain? Which would lose? What would it mean for investment? So what the paper does is really try to give some first very rough and based on some pretty heroic assumptions, tries to give some first answers to a number of these questions. And I could say a bit about what we think the answers are. So for example, we find that residual profits are actually quite large, but they're very concentrated in a relatively small number of firms. We find too that movement to a scheme of residual profit allocation that made heavy use of destination-based sales might actually be better for lower income countries than for higher income countries, everything else being equal. So we think, and we look to an impact on investment. We find it hard to see that this scheme would have a greatly positive impact on global investment. But I think the point is this is really just a first effort in thinking about this rather new scheme. And the overarching point I think we're making is that the world is now talking about really some quite radical changes to the international tax system. And it's going to be pretty important to have a better idea, I think, than we do now of what those changes might mean for countries, as I say, in terms of their revenue, investment, and for the overall efficiency of the global allocation of capital.